What would you say if I told you you could collect a paycheck every single month and never work again? That's the dream of most dividend investors, including myself. The idea is that you can live for the rest of your life on the dividends of the investments you've made throughout your working career. Well, today we're going to talk about two really interesting monthly Canadian dividend ETFs. And the key, these are solid, classic style, high dividend ETFs, which means they own the companies. There's no covered calls. There's nothing synthetic. You're not trying to generate income with the portfolio. It's simply a well-diversified ETF of high quality Canadian dividend paying stocks. Welcome to Golden Arch Investing. My name is Liam. On this channel, we love to talk about investing in Canada. If that interests you at all, please do subscribe to the channel. Today, we're going to dive into two stocks, and I will show you them on the screen. I will walk you through the pros and cons of each. The first one up here is VDY, which is the Vanguard FTSE Canadian High Dividend Yield Index ETF. It's an index ETF. It's tracking the Vanguard, the FTSE Canadian High Dividend Yield Index. So basically, it's a collection of high quality stocks. Right now, the net asset value price, so the price per share of this ETF is $49.60. You're looking at a management expense ratio of 0.22%, which is not super low, but it's also not crazy high. And you're looking at a 12-month yield of 4.38%, which again, not super low, not super high. Here's the key. Let's scroll down a little bit. You'll see big total assets, 3.43 billion total assets. It's been around since 2012, holds 56 stocks. So it's pretty concentrated, but 56 is still a bigger portfolio than you or I could adequately manage, could make actually smart decisions about. It follows an index, right? It follows the FTSE index there. So it means that the portfolio manager doesn't necessarily have to make all the decisions about what a good stock is to fit in this portfolio. They're just making sort of weighting decisions. They're following a benchmark, which they have kept up with. And of course, they pay out a monthly distribution. And lots of people have owned this stock. So let's look at some total return numbers, okay? And again, total return is probably my favorite way to look at return numbers. And with something like this, it's the only way, really. So total return, if you're looking at monthly return, saying you're making about 2% a month. Not crazy, 3 months, 4%. This year so far, I mean, it's the start of Feb, so basically 1 month, again, 2%. The last year, 24%. That's impressive. That's like S&P 500 levels. On average, the last 3, about 8%. Last 5, about 12. And since inception, about 10. If you look at cumulative, pardon me for the loading time, but if you look, some cumulative results, you're looking at 200 and something percent in the last, 13 years since 2012. So pretty happy with that. Another really interesting graph they show us here, the growth of $10,000 invested. And I'll show you the since inception numbers because I think that's the best way to look at this again. You have some ups and downs, obviously. Looks like a sort of down period into the end of 2015. Obviously a pretty down period in 2020. A little bit of a down in that start of 22 when that sort of correction occurred. Then a lot of up since then. But look, $10,000, 12 months, you're looking at $32,000. So not only is this paying you out every single month, but it's also returning pretty good value. Like, yes, there are lots of ways to get a monthly paycheck from an investment, but this is still growing. It still fits that dividend growth mindset where your investments are going to keep up with inflation, which is huge because if they don't, then you're functionally taking a pay cut every single year. This is going to keep up. Risk and volatility. So how risky is this? Well, it's got a beta of about 1, which means it tracks just about perfect with the index. Standard deviation of 13%, which means it's tracking this index. It's done a pretty good job. Again, we're talking about 53 total stocks in the fund. A solid PE ratio, 14.5%. Not crazy, not perfect, not crazy. Price to book 1.7, return on equity of 11.9, earnings growth of 4.3. Lots of good numbers, and this is entirely exposed to Canada. which is maybe the one weakness of this strategy. But again, if you're looking at something like this, you're probably looking for Canadian specific investments to go alongside maybe a more diversified overall portfolio. Let's look at some of the exposure. Financial is going to be huge here. It's a concentrated fund. If you think about the best high yielding dividend payers in Canada, they're financial. So of course, there's going to be a large number of financial companies, 18. Energy, we're looking, sorry, not 18 total companies. It's actually 59%. Energy, we're looking at about 28%, right? Again, energy pays a great dividend. Most of these energy companies, we got utilities, pay a great dividend. Telecommunications, thankfully, mercifully, not a huge part of this portfolio because, oh, that poor industry. And then also all sorts of other little allocations in other areas. Top 10 holdings. I love just about everything on here. I like Royal Bank. I like TD, although we'd really like to see them not mess up so often. Enbridge, obviously, I like. We talked a little bit about BMO, a little bit about BNS, Bank of Nova Scotia. CNR, obviously, Canadian Natural Resources Limited, which I guess is ticker CNQ, is a great company. Love them. CIBC, Manulife, TC Energy, Suncor Energy. Lots of great names on there. And of course, we could go down and down the list and there'd be lots of other great names. High quality companies. It's a great option. And again, that yield of in the 4s is a pretty safe place to be while this fund grows. Let's jump to our next option here. And it's very similar. This time, however, we're going over to BlackRock. It's the iShares S&P/TSX Composite High Dividend Index ETF. And it's a little bit different, okay? Again, monthly dividend income, low cost, and it's a long-term foundational holding. I love that they put this right up at the front because, again, the difference between something like this and a covered call monthly fund or a monthly REIT is that these are supposed to be diversified and long-term. This is a buy and hold forever option. Let's look at some of the numbers here. And of course, it's in a slightly different order because it's from a different provider. But they show us growth of a hypothetical $10,000, obviously a different time frame. But you see, obviously, it looks like it's growing pretty fast. We can see that same 2020-ish dip. We can see things growing at the same kind of rate. Total return percent, average annual percent over the last 10 years is about 7, which is not terrible, right? Again, that's definitely above inflation. Net assets in this one, it's a little bit smaller. So we're talking about 1.7 billion. It's on the TSX. Obviously, it focuses on the TSX Composite High Dividend Index. So it's tracking that index. And it has 75 holdings. So slightly broader base, but also slightly lower return on year. Obviously, this is a drip program, slightly higher PE, but look at the yield. We're looking at a distribution yield of 4.8%, almost 5% on a diversified ETF. That's impressive. We're looking at a 12-month trailing yield at almost 5.5. Wow. We're looking at a PB, price to book ratio of 1.59, and obviously pays out a monthly dividend. We can go through a couple extra things in here. They show some of their holdings. I think this is important again to look at. We're looking at TD, Enbridge, Suncor, TC, Canadian Natural, Royal Bank, all sorts of things in there. A couple of things that are going to be a little bit different. They got a bigger exposure to TELUS. We're seeing Nutrien up there in the top list. So it's slightly different, but it's still a good option because at the end of the day, no matter which one of these you pick, it's a great choice to simply have a diversified portfolio of good quality dividend paying stocks. And if you were looking for an index option, an ETF option, there is nothing wrong with these. And honestly, I'm sure there are lots of others by other providers that are simply smaller or maybe newer that I haven't personally looked at. But buying one of these index tracked ETFs is a great option. And it's a better option for most of you than trying to build your own. And honestly, it's a better option for just about everybody who's not interested enough in investing to look at something like this. Because if you're not interested in investing, or if you have a friend who's not really that interested, but they want to invest, for me, it's family members. These kind of options make a lot of sense. My parents are at that age where they're looking at, okay, what's next for us? This is a great option. There are lots of people out there that have the same kind of place in life where they're looking for a way that they can invest. They can have a diversified portfolio. They're looking to invest in Canada, take advantage of some of the tax advantages. They're looking to make dividends because that monthly income is so awesome for budgeting. There's some great options here. And I'm sure there are lots of others. These are my two favorites right now. If you enjoyed that video, if you want to talk more about Canadian investing, please do subscribe to the channel. It makes a huge difference and doesn't cost anything. And of course, I hope I see you in the next video.